Welcome back to FinScribble, everyone. Imagine logging into your brokerage account and seeing a massive, flashing red -43% right next to Netflix. Your first instinct, like most retail investors, is probably to celebrate, right? You think, incredible, one of the greatest tech giants on earth is sitting on a 43% clearance discount. Meet Jordan, who is currently staring at that screen with cash ready, convinced he just found the deal of the decade. But here is the dangerous truth that catches millions of beginner investors completely off guard. Down and on sale are not the same thing. A stock can fall off a cliff and still remain deeply expensive relative to what the business actually earns. Today, we are going to break down why blindly chasing huge price drops is how investors catch falling knives and the single metric you need instead. Let us dive in. To understand why a steep drop does not guarantee a real discount, let us look at a simple real-world example. Imagine walking into a high-end luxury boutique and spotting a designer leather jacket. The original price tag on the collar reads an absurd $2,000, but today there is a bright red sticker boasting 40% off. You do quick math in your head and realize the new price is $1,200. Now, ask yourself, is a $1,200 jacket actually cheap? Of course not. It is certainly cheaper than its original outrageous price, but $1,200 is still a massive amount of money for a single coat. Maya steps in to remind us that retail stores use inflated anchor prices to make big numbers look reasonable. In the stock market, anchor bias operates the exact same way when investors confuse price drops with value. So, how do smart investors cut through anchor bias? The answer is one foundational tool: the price-to-earnings ratio, or PE ratio. Think of the PE ratio as the true price tag of a business, showing exactly how many dollars you are paying today for every single dollar of company profit. When you buy a share of stock, you are buying a piece of future earnings. Even after dropping 43% from its all-time peak, Netflix trades at 21 times forward earnings. That means investors are still paying $21 today for every $1 of profit Netflix is expected to make next year. Compare that to the broader market average, and 21 times earnings is far from a rock-bottom valuation. Maya points out that while Netflix is certainly cheaper than it was at its dizzying peak, paying 21 times profit means you are still paying a premium price for growth. To understand whether 21 times earnings is a bargain, we have to look back at history and distinguish between mispricing and repricing. Look at the last two times Netflix experienced a massive 40% drop. In previous crashes, investor panic drove valuation multiples down to historic lows, creating genuine mispricing opportunities where high-growth assets were tossed in the bargain bin. But this time, the story is fundamentally different. Netflix is no longer an explosive, hyper-growth startup expanding into untapped global markets. It is a mature, dominant media giant facing plateauing subscriber bases and intense streaming competition. When growth slows down, the market recalibrates what it is willing to pay for future earnings. That is not market panic or temporary misprinting. That is correct repricing. The stock did not become super cheap. Its valuation multiple simply adjusted to reflect its new reality as a steady, mature business. This exact confusion is how retail investors catch falling knives in market downturns. The down equals bargain reflex tricking Jordan is a classic psychological trap. Imagine seeing a sharp, jagged downward line on a trading chart and reflexively reaching out with open hands to grab it. When you buy a stock solely because it fell 40%, you are catching a falling knife before checking where the floor actually is. If the business fundamentals have changed or growth has decelerated, that knife can easily drop another 30 or 40% from where you bought it. Maya points out that institutional investors do not look at percent off the high. They evaluate discounted cash flows and price-to-earnings multiples. Relying on price drops alone leaves retail investors holding overvalued assets, while institutional traders comfortably wait for realistic valuation floors to form. The fix for this common retail mistake comes down to replacing a misleading mental shortcut with one definitive calculation. Stop tracking percent off the high and start measuring price to earnings. Before you click buy on any stock that seems heavily discounted, ask two simple questions. What am I actually paying per dollar of company profit today? And has the long-term growth trajectory fundamentally changed? Jordan puts away his hasty buy button and pulls up a clean, comprehensive financial dashboard alongside Maya. When you evaluate true valuation metrics instead of surface-level price discounts, you make a powerful shift from a reactive gambler catching falling knives to a disciplined investor building long-term, sustainable wealth. Next time a major tech stock drops 43%, remember that cheaper than its peak does not mean cheap today. Always check the PE ratio, verify the growth, and protect your hard-earned capital. As always, appreciate you hanging out today. See you in the next one.